Hey, good morning, guys. Welcome to Market Mondays, or really Market Monthly. With this, we're going to be recapping the entire month since last month. I apologize, the last 2 weeks I haven't really done any videos just because we've been really busy with the big transition as well as moving into my new office, which I am in here now, and it's a mess. So that's why I blurred the background. That way you don't see what it looks like yet. Anyway, before we get started, get right into it. Do a dad joke for you. What is the worst/best place to fart? Worst and best place? The Apple Store, because they don't have Windows. All right, so getting right into it. So I'm going to share my screen, give you guys an idea of what I'm going to be showing you guys. So why this is important is I'm going to show you guys what has happened with inflation over the last couple of years and what has come out last week. So last week came out the 2 inflation reports, 2 of 3 of the month. The core, the CPI, Consumer Price Index, and we have Producer Price Index. These come out one day after the other. Now, what's interesting about these 2 graphs is that they kind of look pretty similar. Now, what happened to mortgage rates last weekend is that because inflation showed up going up, and you can kind of see that little blip at the very bottom here showing it go kind of sharp higher, is that mortgage rates responded to inflation going higher slightly. However, this was expected. Okay, so this was expected for the inflation rate to come in higher. Some of the reports came in a little bit higher than expected, but for the most part, there was a lot of anticipation that the inflation report would come up higher. Now, does that mean inflation is going higher? Not necessarily. It just means that's how the calculation worked. The calculation works that is a running average of the last 12 months. So if the last 12 months have shown higher numbers, that's what you end up seeing, and inflation will go up higher. So if you kind of average these numbers, all these numbers, these high numbers here, you'll naturally at some point get to a point where there's more high numbers than there are low numbers. Therefore, there might be a report showing that inflation comes in higher one of these months. So that was expected, and that's how mortgage rates responded. Same thing with the Producer Price Index that came out the second day. It did show up a little bit higher and kind of plateaued a little bit, but we're still expecting inflation to come in lower. How did that impact mortgage rates? So let's kind of take a look here. Now, this is a graph with conventional and the average VA rate. And you can kind of see that on Thursday and Friday, rates went up basically a 0.5%. It was a lot, 0.5%. So we did see kind of a low numbers from here, and pretty much I locked everyone around this time, right? And this is why it's really important what's going on with the economy when it's best to lock the rates. So there are times when rates are at lowest in comparison to the other moments, but you can kind of see these nice little blips here where it's a good time to lock depending on the situation and what's going on with the economy. So there is a technical signal that's happening right now that we're expecting things to turn, but we'll see how that goes. We still have one more inflation report at the end of the month called the Producer Consumer Index, or expenditures. And that's the big one because the Fed is monitoring inflation based on that report. So how they're going to react over the next couple of months is based on those numbers. That comes out monthly. All right, so the next thing I want to show you guys is the initial jobless claims. So one thing to really be mindful about is what's going on with the economy in regards to the unemployment rate. Why this is important? Because it tells us that there's going to be an upcoming recession. And how do we know that? Well, I want to kind of show you guys a graph that when unemployment's at its lowest, the impending doom is a recession, which means a lot of people are going to lose their jobs. So one example is around here. This was, I think, the 2008 era. Here we have just prior to 2020. This is the 2020 was a recession. You can see that unemployment rate really got at its lowest, and all of a sudden it spiked up. Now we're kind of in the same position. The employment rate's around 3.7 now, and if it goes any lower, or it's showing to be plateaued, and it's about the same level where we were in 2020, where we saw the unemployment spiked up due to a recession. If you look back in history, we're back lower than where 2008 was. So one of the biggest signs of an upcoming recession is unemployment rate being at its lowest. It's pretty much plateaued at this level. So, and there's always been a huge talk of a recession. So that's one of the big things at 3.7. It's probably one of it's at its lowest. So that's why we feel like there's a strong recession coming up. The next thing is home appreciation. So one of the things I want to pull up is called the FHA and the FHFA housing price index. So these two things monitor what's going on with home appreciation on a month-to-month basis. The next one is called the Case Schiller index. These are year-over-year numbers, but for the most part, this is a month-to-month and this is a year-over-year. Case Schiller has showed, and for all of you guys who were in the business in 2020, we saw massive appreciation in 2020, in 2021. Of course, with how rates have changed, the economy and stuff like that, the level of appreciation has dropped to relatively negative levels. And honestly, it's relatively a good balance because you kind of see how long we've been in this era of positive appreciation. We're definitely due for something that just kind of helps level out appreciation. So we saw massive appreciation these couple of years, 2010 and then 2020 and all that stuff. So it's not a lot positive. It's finally that it's nice to see a negative because now things are supposedly leveling out. FHFA, it's also seeing on the month-to-month basis that home appreciation is still up back from where it was at the end of the last year. So still a lot of positive movement with appreciation. And we're still, and next year with rates getting better, we're expecting home appreciation to even go positive. Why is that? Well, most times we're in a recession, I did this video before, if you guys were able to follow along, is that when we're in recession, home prices actually go up. So the only time it's went down is during the 2008, which again is a systematic failure of the mortgage industry. So if we're seeing these numbers during a recession and we're seeing somewhat of a relative number here, then what's going to happen is that we're most likely going to see high appreciation next year coming with the recession. So home appreciation, home prices is going to remain strong. And one of the things that drive that is not only do mortgage rates impact that, but also supply. There's not enough homes in the market. And so a lot of people who think there's going to be a home bubble or a pricing bubble really don't understand why a bubble exists in the first place and don't understand what drove the market in 2008. We're not in a bubble because right now we don't have enough inventory. And if we had more inventory and the home prices were inflated for what the demand was, that's like if iPhones cost $1,500 but no one was buying them, and you can get the same quality phone for $500. That iPhone is a bubble. Like that pricing is a bubble. So that's an example. In this case, we don't have enough homes. So if anyone tells you that we're in a bubble, I believe they're fully incorrect because they're just saying things because they feel like home prices are too high. It's basically their excuse that home prices are too high, that there's a bubble, therefore it will crash. What crash? There's going to be no crash. So, and again, the crash has nothing to do with the housing market. It had to do with the failure of the mortgage industry. So anyway, that's all I got for you guys today. Hopefully you guys got a lot of great information in regards to what's going to be happening with home prices, what's going to be happening with inflation and all that stuff. We do expect overall inflation to stay lower, and eventually that will mortgage rates will eventually respond to how low inflation is. So waiting for that moment. It's going to hopefully pop at some point. We're looking forward to it. That's all I got for you guys. Nuke out.